Ever wonder why some multifamily deals soar while others barely break even? It all comes down to rental demand. Too many investors buy on price alone and they ignore critical data, ultimately leading to low occupancy and bad returns. In this video, you're going to learn exactly how to analyze rental demand so you can confidently target markets primed for robust cash flow and unstoppable appreciation. John, it's great to be here with you.
So good to be here, Mark. One of the things I like to really focus on is the areas we choose to invest in, because at the end of the day, you can have the best asset, but if it's not in the right location, it's going to underperform. So I love digging in to the areas that we're investing in. So this is an exciting topic. Looking forward to diving in.
Yeah, right on. And if you want to learn more about investing with Faris Capital Partners, go to fulloutinvesting.com. We actually have a full video there that talks about our 10-step full out investing process. And we actually have a sample deal there as well. So you'll know exactly the type of deal that you can invest into when these deals become available. Once you go through and watch that video, you can actually book a one-on-one call with us to ask any questions that you have. But go to fulloutinvesting.com, and by doing that you're going to learn a lot, not only the types of deals that we're investing in. You're going to learn about where we're at in the market cycle today and why I believe, and John, I know Faris Capital, our position is that today is one of the most incredible buying opportunities of real estate in our lifetime, actually. And we get into the where we're actually at in the market cycle and actually how we protect the downside, amongst many, many other things there as well. So go to fulloutinvesting.com.
Yeah.
So, John, the rental demand, I mean, this is something that's really important because you could buy something at a really great price. But if you don't have enough potential renters that want to stay in that building, well, all of a sudden you start to have a huge amount of vacancy and you have empty units, and all of a sudden your property is not bringing in the income that you expected. And so rental demand is a very significant thing to not only to understand what's happening today, but what's going to happen down the road. And the beauty with multifamily is you can predict in a large extent with some of the data that we have access to of what's actually going to be coming down the pipe in a very methodical way.
Yeah, it is so critical you get this right. I said it earlier, but the best asset in the bad location will mean bad returns. And so, some of this stuff kind of goes without saying, right? But when you have high rental demand, you're gonna have better cash flow, better pricing power, lower vacancy. But these demand drivers that impact and inform that demand are almost more important, right? So in other words, it's not just what's happening today, it's what's happening 5 years from today. If you have a 5-year, 10-year hold, you have to look that far into the future. Now, nobody has a crystal ball, but there are a lot of clues, right? And so this goes back to looking at those signals and interpreting those signals to make an intelligent decision. So those three key questions, right? Are there enough people moving here, right? Because, past performance does not give you that view of future performance, right? So if you buy an asset today that has great occupancy, but you look ahead and you see that there's actually going to be, lost population, right? So, states like California and New York are good examples where, this is all submarket driven, to be very clear. But if you look at California as a state, more people are leaving than are coming. So they're actually reducing their population. So over a long timeline, that's going to have an impact on your investment if you're not super thoughtful about the submarket you're investing in. That factor of, can the residents afford what we're going to offer? So in our world, we take an asset and we improve the property through strategic renovations and exterior improvements. And by doing that, we raise the rents. But if we're not careful, we may raise the rents too much, and now people in the area can't afford it. And then, the competition, right? Which is sort of what you were alluding to. What's coming up? What's in the development pipeline? And, often those hot markets attract the most development. So what's hot today could be cool tomorrow because of overdevelopment or too many units coming online too quickly.
Yeah, right on. So are there enough people moving into the area? Can tenants afford to pay? And what kind of competition is coming to the market? And if you have those three questions answered, you're well ahead most potential buyers, and that's going to help predict in a very large way what your future rental demand is when you're buying a multifamily investment.
That's it. Yeah. And, there's sort of like I guess a half a question to ask after the third one. It's like, will that new inventory be absorbed and at what rate, right? So, there are areas, Florida's a great example because the population in Florida is exploding. It's a state with no income taxes, and it already had a relatively lower cost of living than a lot of cities, say, for example, in the West and the Northeast. So post-pandemic, it's experienced an explosion in growth. And prior to that, it was already growing. And so there's pockets like where our investment in Largo is a good example, where there's been a decent amount of new supply, but it's all getting absorbed. And so we look ahead 5 years and we realize that that pipeline of new development has effectively slowed to a stop. So it's meaning that even if we have a little temporary, sort of reduction in organic rent growth, we're going to see a spike as that new supply is absorbed. So, it's not just one data point. You have to kind of go, almost like five layers deeper, right? Peel back the onion a little bit and really get the full story.
Yeah. And this is one of the biggest reasons why I believe today is one of the strongest times to invest, because over the last couple of years, there wasn't a lot of new development.
Yeah.
And there's still a lot of people moving into these high growth markets that we're buying these properties in, markets such as South Carolina, Charleston, right? Tampa, Florida, Atlanta, Georgia. Like, people are moving in there. But the last couple of years, developers have said, listen, interest rates are too high. There isn't demand right now. There's a lot of uncertainty. So I'm not going to start a project. Now, in the meantime, when the market was at its peak, they sold these developments, they started building them, and now they're being absorbed into the market, as John, you had mentioned. And absorb basically means the new buildings come online and they get rented up, right? Those units that are coming available, those apartments, people are renting them, which means they're no longer available. And so that's what absorb means. The new unit comes on, is delivered to the market, and then it gets absorbed by somebody actually renting it. And so we have basically a couple years of really no new development. Now, there is some, but not anywhere close to the amount of new demand that's coming into the market. So, John, like, over the next couple of years, we're going to really see, 2025 is it depends which area that you're buying these properties, but we're projecting rental increases moving forward when it comes down. And with rental increases, that increases values of these buildings. And it primarily because a lot of these new developments haven't been getting built. And so you have more demand than supply, and that drives prices. And so that's one of our strategic, we'll say, thesis points right now, and why we believe today is such a great spot for real estate investing.
Well, and to take it a step further, right, we're now in a place where, the U.S. administration has impacted, tariffs, or, implemented tariffs, I should say, which are impacting things like materials cost. And so while that can be stressful and concerning, right, and, there's a plan there, but while that plan is in motion, there's this temporary disruption. And, that may make you think, wow, is this a good time to invest? But it's actually why we love the types of assets we buy, which are existing assets that are in great areas, great bones, well developed originally. And so we can come in and put our stamp and touch on it. And so, Mark, if somebody's building a brand new apartment building in today's world, to deliver a unit, you're probably looking at anywhere from about $280,000 a door upwards to about $350,000 a door, depending on the area and the class and sort of the quality of what's being built, right? So a brand new, just top to bottom, awesome Class A with all the bells and whistles and amenities, you're probably in that upper 350 range. And so because of that, you may say, well, does that make it a good time to invest? Well, absolutely. For example, we bought our Largo deal at $165 a door, our Charleston portfolio deal at $168 a door. And so by going in and adding $15,000, $20,000 to these units, as well as the exterior, we calculate a total all-in cost. We're so far below what it would cost to build new that as the development slows and then eventually picks back up in 3 to 4 years, our value will be brought up because, we bought it at such a discount, and it's such a discount to today's, value and today's replacement cost. So it is 100% to me, the best investment you can consider right now is investing in apartment buildings, because another factor, Mark, that we touched on previous podcast is that it is now more expensive to own. It's about $1,200 more to own than it is to rent a similar property. And in times of uncertainty, people are going to take that more conservative approach and rent. First time home buyer in the United States is now 38. It used to be 28 to 30. So we're seeing it, right? So these are all the things we're considering when we're making a decision. Now, you might ask, Mark, like, if I'm an investor, how do I decide, or how do I, get this information? How do I know if this is a good market to invest in? And there's some ones that come to mind probably pretty, simply, right? It's like the census data, right? You can go look and you can see, what does that look like? Is population improving? What are the projections look like? But Mark, there's one that we love that's a little like less thought about, and that is the U-Haul one-way mover report. So U-Haul publishes a study on an annual basis, and it shows where are people renting a truck and where are they going with a one-way move. So markets like Tampa, markets like Charleston, market like Atlanta are on that top 10 list. So that's an interesting data point that maybe you wouldn't naturally think of, but it's a great data point. Another one is the United States Postal Service also publishes data on changes of address. So where are people changing their addresses to? So those are two data points alongside the census data that we leverage. And then you can go deeper, right? So we use CoStar.com, which is a great resource. It's quite expensive. We invest in that for a variety of reasons. But it's basically a listing service for commercial real estate assets, but it goes very deep on data. In fact, they have a team of data scientists, somewhere like around 1,000 people analyzing every market in Canada and the US. And so we can download their demographic reports that not only show the projected population growth, but it shows the average and median income, the median home value. It shows what sectors of employment are people in this area working in, and it's all broken down. So for example, if we were looking at an area and we saw that 10, 12% of the population was working for the government, and knowing today that the government is downsizing, that's something we'd have to factor in or consider. Or if we saw that 50% of the population was working in one sector, that's a big red flag. So it's beyond just population and like, is the area growing? It's all these other factors you have to look at in terms of renter demand. So, we touched on this earlier, but that affordability factor, right? If we over improve the asset and raise the rents to a point where now all of a sudden it's 40+% of somebody's income to rent the place in terms of the average and median income, then that's one we're going to walk away from. We like to see something at highest about 30%, 32%. 35 is probably a walk away. But if we see something in the 20s, that's an area we love. That's an area we're going to want to invest in.
Yeah, and we also like to look at what are single family homes selling for in the direct neighborhoods that we're buying.
That's right.
Anytime we can buy an apartment for half of what a single family average sale price home is, like right in that same area, that's really good value for similar square footage a lot of times as well. It's incredible what you can get these apartments for. And so we really like looking at the neighborhood that we're buying in, and we want to get a good deal. Obviously, you're buying more units. You want to get better, we'll say, bang for your buck, for your dollar when it comes down. So yes, diversity and employment. And, John, it really makes sense that when you have massive employers that are bringing thousands of jobs into an area, they're going to go to a place that they're very confident will provide the proper labor force for them to actually make the move, because it's not like they're going to test out making the move. They have to know that they're going to have the employment available for them. And so if you have these big, massive factories moving into an area, you better believe that that's a really good place to invest, because, jobs bring people, and people, they need beds to sleep in, and that's our business. And so we track that. And, the CoStar is for us, we spend tens of thousands of dollars on that to be able to get that, to make sure that our investors have the up-to-date information so that they get a competitive advantage. But, you can do a lot of it on to a certain degree. You can do a lot of it just by going on some of these government websites, going to the city, and actually even calling the planning department and just calling them up, say, hey, listen, what's going on in the area? What the kind of data can you share with me? A lot of times they're really great. And the chamber is actually really good as well. We've taken advantage of that, and over the years, they've been very helpful for us to be able to provide this information for us.
That's right. Another resource is this is one that's not available in all markets of the US, but the major markets, bizjournals.com. So it's the Business Chronicle. So Tampa, Atlanta, New York, a lot of major cities. So Charleston does not have one, but Tampa and Atlanta do. And so I can go through there, scan through, and every employment announcement that is happening in the area is going to be talked about on that site. But to your point, the county, the Chamber of Commerce can provide that information. And so I think about the portfolio in Charleston we closed on, where Volvo had just built a massive manufacturing facility less than 20 minutes from our asset. Not only was it a manufacturing plant, but it was also part of their technology infrastructure. So data service jobs and all this stuff happening. And so that's huge, right? That's absolutely something that, will have an impact. But what happens is when a major employer like that comes into the area, now all of a sudden, all these other businesses start growing around it, because when population comes in, right, there's got to be more real estate agents, more bankers, more insurance brokers, and it just all sort of compounds. So that's why we like to look for those big employers that are coming in with, the 500, 200, 1,000 jobs, because when 1,000 people show up in an area, that in and of itself has an economic impact, right? And more services and retail starts to show up around it, right? And, Mark, we sort of joke about this, but it's not really a joke, but it's like, if you see a Chick-fil-A or a Target or a Walmart nearby, you start going,
Starbucks.
okay,
Yeah.
these
Good old
guys are
Starbucks.
smart, a Starbucks. That's right. So we call it like the Chick-fil-A index. But if I see a Chick-fil-A and a Starbucks, which our Monk's Corner asset has literally both of those across the street, you go, okay, these guys are pretty smart. They're not going to build a Starbucks or a Chick-fil-A here if they don't think they have the customer base. So that's once again, it's almost a joke, but these are all the things we're looking at. It's more to illustrate the point. It's not one thing; it's like 20 things you have to look at, right? But the Bureau of Labor Statistics is another one. You can Google search the Bureau of Labor Statistics, and that'll show a lot of breakdowns, unemployment rate, things like that. So generally speaking, in every area we invest in, and when I say area, yes, you might think Tampa, for example, or Charleston, but we're really actually talking about the submarket. I don't want to see much more than maybe 1.5–2% unemployment, right? In the United States right now, the unemployment rate, we're recording this in March of 2025, is around 4.1%. So if I see the unemployment rates 1.5, 1.8, that's another, check. Boom. We like that because people are working. It means there's jobs, and those that are looking for work are able to find it, right? So it's not just about jobs; it's also about unemployment, right? And that tells a big story in and of itself.
For sure. And so the next thing we look at is the new construction and supply pipeline. So, John, you and I were super competitive. Like, we like to win. And so we like our apartments to win as well. And so why we look at this is because when you have new competition coming into the market, well, some would say, listen, that's really non-competition because it's brand new A-class building, right? And we buy B class, but we like to compete with the A, as in we like to be better value than the A. And so what happens sometimes when you have these large developments coming into a new market is that they'll offer concessions, and sometimes they'll bring the rents down to get it leased up. And when they bring it down, all of a sudden maybe that gap of extra value that you were getting in your apartment, that actually doesn't look as strong. And so that can impact your overall occupancy and the kind of rates that you're getting. And so we want to know what kind of competition is coming down the pipe. And so the cool thing is that they publish the number of permits and expected completion times in the area that you're actually buying your assets. So we do a lot of research knowing, okay, listen, this is not only when we drive around do we look at, okay, there's new development here and there, but we actually look at, okay, that section of land, what is planned there? And there might be permits already issued there. And on the permit, we'll be able to see how many potential units are coming down the pipe. And we want to know that. And so for us, it's no excuse for us to say, hey, listen, we didn't know this was coming. It's like we do our research because we know what's coming, a year, 2 years down the road in the assets that we're buying, which allows us to win. Like we like to play the game to win. Yeah. And so we want to know what's coming down the pipe. And the cool thing is now with data, I mean, you can get ahead of all this stuff.
That's right. And, so much of that, right? So we know there's new Class A being built, and, you can generally get a sense of what their projected, rents are going to be, right? So if you're buying a Class B, and you can go in and add some amenities that have that same look and feel. So for example, we have a deal we're looking at right now that we hope to get some good news on in a few days. And our plan there is actually we toured all the brand new Class A assets. I mean, stuff that just got delivered like a couple of months ago, right? And we did full tours. So we walked all the amenities, units, everything. And so we actually got some great intel on things we could be doing from a design perspective and from an amenities perspective. So what we realized is that our building that we're circling is much more generous when it comes to the square footage. The floor plans are phenomenal. So, we're 300 more square feet in some cases than these newer developments are able to offer, just because, once again, these materials costs are having a real impact. So you're building smaller units at a higher rent. So we're going to have a bigger unit at a lower rent, but add the same features that those have. And so, gosh, we were even taking photos of like their leasing centers and amenities, because we're like, I like that color. I like that painting, right? And then we give it to our designer and say, hey, in a sense on a budget, although we don't cut corners, but like, can you generate and turn this leasing center into something that looks like that? And she's like, yes, I can do that. Can we take this pool that is beautiful, but just looks a little tired? Can we maybe put some new furniture in, put some fire pits, some bistro lighting, and really, some hammocks, and just kind of create a cool vibe? And we learned so much, right? And so the beautiful thing is that a resident renting from us is able to get what feels like a new Class A unit, but at a discount. So, you want to know for a variety of reasons. Most importantly is, how is this going to impact my ability to rent my unit? But there's the secondary factor of, is what can I learn from this, and how can I apply it on my building, so that when somebody looks at both of them and they see ours is $300-400 less a month, it's like a no-brainer. Like, this is the one I want, right?
100%. We want to be the shiny penny. And
Yeah.
so we're always putting ourselves in the resident's shoes, as in, listen, here's all the opportunities out there for them to build a rent, because we know our residents, they have options. They don't have to take our unit. They have other potential options that they can get into. So we actually pretend we're residents. Now, we tell the other apartments, we tell them that we're doing market research. We don't lie to them or anything, but we like, when we're looking at the units, we're pretending we're residents when we're looking, and we want to look through their eyes, and we're like, okay, we can get this for this price. We can get this for this price. What are all the extras? And we ask those questions. And then we actually say, listen, do we believe that we can get X? And do we believe we can maybe push the envelope a little bit there, or are the margins too tight? And so, for example, in one of our last walkthroughs, we really liked the building, the tours that we did, and we're like, listen, you know what we thought perhaps we could get for rent, I'm not convinced that we can get that easily.
Yeah.
Now, we probably could, but it was not that much of a slam dunk. And when we're going in and we're having our projections, it needs to be a very much a slam dunk. And when we're looking through the eyes of the residents, to say, yes, this is going to be exceptional value. And the cool thing is that we've done that now, John, and we're seeing this, is that we're overshooting our projections. And that's just a much better message to our investors, that we're overshooting projections versus, we're either hitting or we're actually coming short.
That's right. Yeah. So some green flags, Mark, when you're analyzing rental demand, right? So you want to see population growth above the national average. So that's number one. So are more people moving here than are leaving? And does that rate exceed the national average? One thing we sort of touched on, but probably could go just a bit deeper on, I won't spend too much time, but is not only strong economy with job growth, but also diverse economy, right? So I kind of hinted around that when I mentioned, 40 something percent all working for one sector. But, you wouldn't want to buy in a market, for example, that is 100% driven by tourism. I mean, there's opportunity there, but that's probably more of a short-term rental, or, sort of a different investing approach. Buying an apartment building in a heavily tourist area. I mean, the pandemic is obviously an extreme example, but it's a very recent example where a lot of those areas just got nailed and people lost their jobs and couldn't pay their rents. And so, just being thoughtful around that economic diversity. So
military is another one of those, right?
That's right. Yeah. And so, we love our veterans, we love our military, and at every one of our properties, there's military. But the reality is that if your entire population is military and there's some form of deployment, by law, you have to release them of those leases. So it's just something you have to factor in. But, an area that has, like I think about Charleston, because Charleston's interesting because I suspect a lot of people think tourism when they think Charleston, and it's certainly a big economy there. But they have defense contractors, they have auto manufacturing, transportation, and then the areas we buy in tend to be strong with your teachers, your nurses, your firemen, your police officers, who we like to call the hometown heroes. And in fact, we even have programs for some of those, population sectors, particularly the police there. We like to look after them. So diverse income, that rental to income ratio should be below 35%, ideally at 30% or lower. That just means everybody in the area can afford it. Vacancy rates, and this depends a little bit because with new supply, but somewhere in the 5 to 10% range. Any lower than that, it's not a run for the hills, but it's let's pause and really analyze this and look 5-7 years ahead and kind of see what's happening, because sometimes it may just be a temporary blip, but sometimes you could look at it and say, no, this is actually a factor in this market. And then that limited new construction, relative to demand. So those are some of your green flags. In terms of red flags, I mean, it's basically the inverse, right? Population decline, high unemployment rate, rent to income's way too high. It's why we would never buy in Manhattan, right? I mean, the rent to income ratio up there is probably 65-70%, and I know people rent apartments all day up there, but that's just not an area we want to be in. Vacancy rates that are above 10%. And then once again, massive construction pipeline. So they're kind of inverse of each other, but worth mentioning. So just as you're analyzing markets, make sure you meet those 5 criteria on the green flags before you move forward.
Right on. So yeah, in summary, growing populations, growing job markets, diverse job market, affordable, lower vacancy rates, oversupply of new construction is not an area that you want to get into. And so just overall, you want to make sure that ideally, if you can buy on the path of progress, so where is the city growing, and you can buy in these we call them emerging markets. And if you can buy in on the path of progress, as in the city is growing this way, man, you can position yourself in such a great spot. So 5 years down the road, all of a sudden they're like, how on earth did you get it for that price? Well, the city grew towards me. And we actually knew that was going to happen. And so this is where you can get an unfair advantage by doing your research. And by doing that, you're going to increase your overall returns. And it just takes some research. Yeah. And you position yourself in a much better light.
That's right.
So guys, go to fulloutinvesting.com where you can check out our 10-step full out investing process. And you can actually check out our sample deal as well to find out more about what our investments look like. We are very close to acquiring our next asset, and we want to make sure that you don't miss out and you get on our short list, which you can go ahead and book a call to make that happen on that landing page. You can go to fulloutinvesting.com. So thanks for listening, guys. If you enjoyed the show, please subscribe and share with other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.